The questions that we had here is, what do you do with declining rent? So obviously you're not doing any more capital expenditures, but what are some of the other things that you're kind of thinking about doing to help you, maintain a positive NOI during this time?
So right now what we're doing is by the way, we're collecting, and knock on wood, we've been so blessed. We've been collecting at high 90s. Across our portfolio, we're about at 97% collected.
Wow.
So we've been very blessed and lucky. So we've been not having to do much, but for example, renewals, we have not, this year, we're not raising, we're staying at the same rental. Everybody's getting no increases on their renewals because it's just, on territory times, and we want to be fair to our tenants and we want them to stay, and we don't want them to have to leave because they can't afford it. So no one's getting an increase this year. Well, we're going to lose on NOI, but it's the circumstances that we're in. We're not charging the late fees to every tenant, just a normal thing. But otherwise, we're really not doing much except trying to be there for our tenants, giving them any resources that we can, giving them like churches that are giving out help to tenants that have lost their jobs, giving them any kind of social grants that they're giving out there, any government help that we know about, opening up the communications with them, trying to come in and, trying to help them out. But really otherwise, on our properties, we haven't had to do much because they're really still paying. So we've been very lucky. We went into emergency mode when all this happened, and we started saying, okay, what do we need to do? We started underwriting our portfolio to see what was the maximum that we were going to be able to sustain without having to pull out money out of our own pocket to cover expenses in the property. And changing it here again, we always, when we buy properties, and this is for everybody, guys, whether you're buying a duplex or you're buying 400 units, it doesn't matter. Leveraging is so important, because when you have tough times, whether it's the COVID, which is or when 2008 when the economy crashed, anything, you got to make sure that if you are in a bad time, that whatever you're receiving, that your debt is being paid, and that your expenses on your property, which includes your employees' salaries, are being covered. It doesn't matter if you're not making money, but that all the expenses on the property are being covered. So when we underwrite our deals, we underwrite 50% expenses. Off the bat, I don't care if the property's collecting 100% and it is, it's on fire. We don't care. We underwrite the deal at a 50% capacity, and that's what we leverage on. So if that property calls for us to put 40% down, then for it to be covered at a 50% coverage of all expenses, then we do 40%, which we leverage at 60%. Or if it's a 35, but we never go lower than 35% down payment, just because of rainy days. You never know. And you have to always worry that your property expenses are covered. Your income, you have to forego that. And right now, one of the emergency modes that we went in was our distributions are on a complete halt. So we haven't been receiving any kind of distribution from any of our properties since April. And we made that decision because we needed to make sure that just in case that any of our properties goes below our 50%, that there's money in that account that we're going to be able to cover all of our expenses and not go into any kind of problems where we can't afford it, or that we have to come out of our profit, our own pockets. And I know a lot of people say, "Oh, but you have so much money, you guys." This, that. We are in the, we're all in different levels, but we're all broke at a different level. So if that properties don't produce enough money to pay the expenses, and I have to keep on going into my pocket and get my savings to pay for that expense, guess what? I'm going to stay without money too, because money just doesn't produce on its own. So my money's coming from those properties. So if I don't protect the properties itself and make sure that all expenses are paid, that my employees are covered, that the mortgage is covered, I could get myself in a lot of trouble no matter how much money I have. So make sure that you guys take that and really grab a hold of what I'm saying and understand it, because you will be able to survive in real estate if you follow the rules that we're due. You will be in real estate forever and keep on making money. Because now when this all gets settled and we go back to our normal life, we're going to have a big chunk in that account of that company of ORTSAC. And then we're going to get all those big distributions and get it back into our pocket. So now we'll be super happy. Our NOIs will be great. And we had nothing to worry about. So, that's a very, very important thing to understand when you're going to get into real estate, is that you leverage yourself properly and that you have a reserve for those rainy days, that you don't need to go into your pocket and try to cover anything to do with expenses.
I love that. And so it's really getting in the deal right, underwriting it very strictly. So I actually want to take this moment to introduce Sterling Perkins. He's my business partner. He's the other half of 6'5 Capital. I know I've talked to you about him a little bit on our previous call, so I wanted to take the time to introduce him. And I know he's got a handful of questions. He's been blowing up the chat, and I just texted him, hey, I'm about to call you in, so be ready. So for the next 12, 13 minutes, he's going to ask a handful of questions, and then I'm going to hop back on at the end and ask a little lightning round. So this is something new that we're doing. So I have 5 or 6 questions that we're going to start asking everybody that we have on our webinar. And actually, we're going to turn this into a podcast. So I should have said at the beginning, this is going to be our first podcast episode. So we're super excited about that. So we got an amazing speaker for our first podcast episode. But Sterling, will you introduce yourself briefly, and then I'll let you run with the questions for the next 12 or so minutes.
Yeah, absolutely. Thank you, Justin. I'm Sterling Perkins. I'm the other partner of 6'5 Capital. Come from traditional capital markets. My family owns 3,600 units, though, up in New Jersey, New York area. I'm a personal partner on a 400-plex in Jacksonville and a 24-plex in Sarasota. So definitely come from the multifamily space, understand it fairly. And for one, congratulations on your collections through this time. We are not seeing that high of collections. So one of my questions is, what are you seeing in the market right now when you start to see unemployment potentially not going to be floating some of these tenants? How are you preparing? What are you preparing for as you start to think about that right now?
So yeah, that's going to be a big issue. And I was going to talk about that, but I didn't want to get off subject. But yes, I think that come, late July, August, if they don't extend this unemployment, we're going to see a way lower collection rate for sure, because right now they had the stimulus, they had the unemployment, they're able to, still survive not having a job. But come July, August, if this doesn't get strained out, which for a fact that at least 40 to 50% are not going to get their jobs back, because these mom and pop businesses just can't survive what's happening. So they can't bring them back to work. So we are, again, like I just told you, we're not getting distributions from our properties. We stopped our distributions. They're inside the bank account for the business. If come July and August, like I said, we underwrite our deals at a 50%. So if 50% of our tenants don't pay, we're still good. Now we go below that 50%. Now we're going to have to step in and have to support that property. So being that we haven't collected our distribution for, a few months, that's what we have that little surviving mode account for. Come August, September, October, we're at least covered because we've already projected for this to happen. So we're prepared, luckily, knock on wood, we're prepared. So we're not going to be in trouble. Is there a lot of landlords that are going to be in trouble? 100%, because most landlords don't calculate that this is going to happen. They don't underwrite their deals that a rainy day is going to occur, and they leverage themselves to the max, and they have no reserves. Unfortunately, for those landlords, they're going to lose their properties, or they're going to have to sell it at a discount so that they don't lose it. At that point, the ones that have that dry powder are going to be able to come in here and grab these properties and get all the advantage, because, there's always a saying, the profit is in the buy. So when you come in this market, come 2021, and you have these landlords that didn't leverage themselves correctly, don't have reserves, and these tenants cannot pay, what do? Yeah. So I do see a problem coming for a lot of landlords, but at the same time, I see a great advantage on being able to take over the market.
So are
and, unfortunately, I hate to say that because I don't want nobody to lose their properties, but it's just a fact of what's going to happen.
Yeah, and business is business. So are you positioning to go and try and acquire? Because, Justin and I have been talking about this a lot. We foresee the same thing. Everyone from 2017 to, the last 3 months that have levered up on, poor underwriting or have taken larger positions than they should have is probably going to experience some difficulty in the near future. Are you positioning yourself to acquire, or are you more in defense mode because you already have such a large portfolio?
No, can't wait. I'm ready to attack when it's time, but we put a complete pause, probably last quarter or beginning of next year for us to buy. We're not moving right now. We've been getting attacked by a lot of people coming into us. Hey, we have a property that's going to go into deep. We're like, we're not buying anything right now because we want to be sure that we're going to buy when it's really a good time to buy, when we're going to take full advantage of being able to buy something that we're going to be doing what we did in 2011, that we were able to buy and make so much profit. We're long time holders. We don't like to buy to flip. So we love to buy assets that we know that are going to be able to be carried on with us for a long period of time and take full advantage of that NOI and the IRR on the properties. For 100%, we're going to come into this market with, full on backpacks and let's hit the road and let's go buy everything we can in 2021. And I would advise everybody that's wanting to get into multifamily investing, hold on, wait, especially if you want to buy the small units. Those mom and pops are going to have to get rid of those properties and you're going to get the best deals. Start getting all the knowledge. If you're not in multifamily yet, get all that knowledge so that when that time comes, you're able to know what you're doing and being able to buy